Okay, so I think we are good to go. First, thank you for joining us. First, let me introduce Dr. Wang Qing, who is online. So Dr. Wang is from Chongyang Investment, which is a leading private securities fund in China. And Dr. Wang is the chairman of Chongyang Investments. So before Chongyang Investments, he has previously worked for Morgan Stanley and IMF. So we are thrilled to have you both, Stephen. And right now I'm in Shanghai. We are waiting for a typhoon. So we really hope that you can bring us the nice weather from San Francisco. Okay. So Stephen, I want to start with you. I did some homework, and you were one of the first students back in the 1990s to study in China. So could you share with us your experience and how does it affect your career?
Certainly, and thank you. I'm very happy to be here and very happy to be here with Dr. Wang. So I actually came to China first in 1982, so it was even a bit earlier as a young man in college, raised on in a very rural community. So this was really my first experience coming to cities and being in a foreign country. So since I was a little boy, I'd always imagined going to China. And so it was a great opportunity to me. And as you mentioned, I was one of the first Americans to study in southern China. And I actually studied Chinese economics and business at that time, and also taught English there. It was an important part of my life and really has changed me forever. I'm very grateful to China and the Chinese people for how kind they were and exposing me to a different part of the world. I think it developed my career in being international and particularly working in what are now called emerging markets. And I'm very proud that I've had the opportunity now to work very closely with China over the last 40 years, including setting up local asset management company in China and being one of the major foreign investors into China. So wonderful experience for me.
Wow, that's fascinating. I don't think there were, so you said you studied like Chinese economics or that might be quite a different story than what we are having now, right?
Economics in China were different than now. Yeah. Yes, and I'm one of the few Westerners that probably knows all of the history of Chinese economics.
Okay, that's great. So let's get to the current world. So inflation in the United States is cooling down and the job market remains rather robust. And in your media outlook, Stephen, you advised that investors probably need to allocate a bit from the money market fund to more interesting places. So what are the more interesting places do you think that investors should consider?
Well, that's a good question. I do want to give a slight caveat that my advice is primarily to global or US investors. It might be a little bit different for local Chinese investors, but at least within the United States, we see inflation slowing and probably slowing quite a bit over the course of the next couple of years. And so while interest rates might go up, they're probably going to go down over the course of the next couple of years. And so it's been a good investment to be in cash or money markets, which now have a pretty high return of around 5%. However, if we're right and interest rates go down, then the return on those money markets is going to go down too. So we would suggest looking at some opportunities outside of cash and diversifying the portfolio. So one of the first places to look would be within fixed income and probably increasing your duration, which of course, if you invest in fixed income at all outside of a money market, you're increasing your duration. But our targeted duration is about the same as the market. And then looking at opportunities with 10-year treasuries at or above 4% now, we think there's a lot of opportunity there. To get extra yield, we see corporate bonds as having a good opportunity. For the first time in a very long time this year, corporate bonds actually have a higher yield than the underlying stocks of the corporations. So on a risk reward basis, we think that's better than equities. We also look very selectively at high yield within a fixed income portfolio, but have some concern around high yield, as if the economy weakens, which it hasn't as much as some expected, but it's likely the economy will weaken, the spreads on high yields might widen a bit. So cautious on high yields and have to be very careful on which you pick. We're also somewhat positive on equity. It's hard to be real positive on equity with how much strength it's had this year, at least within the United States. But within equity, we would look at opportunities within both the quality or higher yielding equities, as well as with selected growth, or what we call innovation stocks. For investors that are concerned about exposure to equity, perhaps what I was talking about before, high yield fixed income could be a bridge between equity and fixed income. We're also fairly positive on global equity meaning outside of the United States. We think that there's going to be more growth in some countries outside of the United States, in emerging markets and in Japan, for example. And also just the United States relatively has come so big and is much more expensive relative to many other parts in the rest of the world. We would see opportunities within alternatives investments. That would mean investments such as real estate. Probably everyone has read the headlines about the terrible problems we're having with occupancy in office buildings. It's terrible here in San Francisco. But we see opportunities in other areas, commercial areas, industrial areas, biotech areas. There's a huge housing shortage in the United States, so there's opportunities in multifamily housing as well. And then within emerging markets, we are positive on emerging markets, both in terms of equity as well as fixed income. So I know that's a lot, but I'm just trying to cover all of the various asset sectors that there now are opportunities. And you'll probably hear me saying this many times, we do strongly recommend that people diversify their portfolios.
Okay, that is almost as true as the tautology in the investment world, right?
Absolutely.
Okay, so Dr. Wang, would you please share with us your thoughts on U.S. market or global market as well?
Sure. Thank you, Juan. And I'm very delighted to have the opportunity to join Stefan and you in this discussion. We share Stephen's view in terms of broad asset allocation. Actually, we have had a bullish view on U.S. equity since late last year, but we are no longer feeling so bullish. We see three potential sources of downside risk right now. First, despite that inflation has come down, the Fed wants to keep financial conditions tight and is still willing to err on the side of being too tight rather than being too easy. This is troubling. History shows that it's the last few rate hikes that in each cycle that usually spell the trouble for the economy and for the markets. We are now in this last stage of tightening. Second, the market sentiment. Market sentiment has swung dramatically from end 2022 through early summer this year. Investors were quite bearish then. Now bears are disappearing, and the investors are more sanguine about the economy and the markets. So from a contrarian point of view, this is a warning signal for a potential shakeout in prices. And the last one, third one, is that back in September last year, the SP 500 forward PE ratio stood at 15 times. Today is about 20 times. So without a meaningful further drop in the long-term bond yield, stocks are no longer cheap, particularly relative bonds. So the bottom line is that we see various potential risks, and the risk-reward profile for the equity index has deteriorated to a point where warrants caution. And Stephen mentioned that with the 10-year Treasury yield now standing at 4% now, we think for the period ahead, bonds could probably produce a better risk-adjusted returns than stocks.
Yeah, that's great. It always amazed me how easy it is to find agreement in the investment world compared to in the political world. So it's great to see agreement between you two. And Dr. Wang, I want to get to China. The market had a rather supportive policy announcement in the end of July. So I was wondering, do you think the market will get what it wants and the economy will get what it needs?
This is a good question and a timely one. Yeah, as you suggested, the Politburo, the highest decision-making body for economic policy in China, met 2 weeks ago, and the policy stance turned out to be substantially more dovish than expected. The meeting acknowledged challenges in economic growth and pledged more forceful, counter-cyclical efforts to stimulate domestic demand, improve expectations, and prevent risks. So the policy measures include demand-side property easing and boost to infrastructure, continued monetary easing, and even include some more consumption incentives, focusing on auto, electronics, and home appliances. And besides this economic policy, Chinese society also pledged to improve business environment for private enterprises, and particularly include a platform. And they also suggest they want to boost capital markets, lift investors' confidence. So we see this as a part of the government's efforts to restore private confidence, revive animal spirits in particular, which is key to sustaining productivity growth, amid these secular challenges, including demographics, debt, and de-risking, and so on. So the bottom line is the Politburo meeting seems to have hit all the right notes that are music to the ears of the market. So this is actually in line with what you mentioned, wishful thinking of many market participants. That's why the initial reaction of the market has been quite positive. The durability of the market rally will, of course, hinge on implementation of those policy statements.
Okay, that's very helpful. And yes, implementation is the key, and we'll keep a close eye on that. So, Stephen, of course, to understand Chinese market, policy is always the key. And what policy stimulation interests you the most at this point?
I'll answer that question. I just want to go back and say that actually economists might agree a whole lot on the future of the economy. And at the end of last year, most economists and strategists would have said that this would be a very bad year for equity and probably a bad year for fixed income. I was actually not particularly positive on equity at the end of last year. So I would just say a very big congratulations to Dr. Wang to turning positive at the end of the year. He was right and very much against the consensus. I and our group turned positive in May, which was still positive in terms of returns, but not as good as Dr. Wang. So I would say there's a difference in view. And I think there's a difference in views even right now, because many strategists have changed their strategy. They were negative before, and now that the market's up, they're positive. And Dr. Wang, I don't want to speak for you, but he was positive before and the market went up, and now he's more cautious. And I would agree with Dr. Wang. So other analysts are kind of trying to catch up. And I think that we are both agreeing that maybe the market's got ahead of itself. So with China, clearly I'm not an expert in China in the same way as many of your listeners or Dr. Wang. So I have the perspective a little bit more of a foreigner. And in that perspective, we were relatively positive about the opening of China as it dealt with the COVID crisis, and kind of expecting a lot of growth after that, which we were somewhat disappointed to see. And I think part of that is because China just had less stimulus, particularly in the hands of the consumer, than we saw in the West. And so China just had a different response than we saw in the West. So the latest meeting of the Politburo was very important. And I would point out that probably a different way that Westerners see China than maybe local China is that, or at least I am trying to look at not just what the government is doing to stimulate the economy, but sort of what is the natural economic environment outside of the government. And I think that ultimately will be what will drive the growth longer term for China. So first of all, of course, and some of this Dr. Wang just mentioned, but the helping with the property sector is very important. So clearly the government needs to step in and more will need to be done, but at least it seems to be a step in the right direction to support the property sector. I think tied to the property sector are the risk management around the local government financing vehicles, which to some degree have been financed, of course, by property sales. So stepping in and supporting those, which is a risk that we see and would be concerned of, is very important. And that's a very important place for the government to step in. And then, of course, the government stepping in around unemployment, particularly youth unemployment, as it's trying to optimize the environment for private enterprises and foreign investments. I think as foreigners, we've had some concern, particularly around technology companies, about what the environment, what the government's outlook and involvement with those companies is going to be. And I think the government kind of clarifying its stance on that opens up potentially for foreign investors, particularly, to feel more comfortable investing in those companies. But I think that the ultimate test will be whether locally the Chinese have confidence in the economy and therefore go out and spend and build companies, and then also to some degree building foreign confidence.
Oh, that's great. You raise up lots of issues. And I think without any doubt, the property sector probably tops the list of concerns of investors in China or outside of China regarding the Chinese market. But I want to bring up another issue, that is demand. Dr. Wang, do you think the regulators in China have enough tools in the toolbox regarding push up demand from both the consumer side and the corporate side?
Well, this issue has really got attention from many observers of Chinese economy, and people have concerns that whether Chinese government has sufficient policy tools. I agree with Stephen that what matter at the end of the day is really the dynamics of the economy outside the government. Speaking of the policy tools, I think people's concerns are legitimate because the aggregate demand turned out to be substantially weaker than expected so far this year, and especially in second quarter. To effectively boost aggregate demand will require expansion of monetary policy, fiscal policy in the short run. And this is what macroeconomics 101 teaches us. Some countries like the US managed to have done so very successfully through massive income transfer program from the government to the household, and helped aided by accommodative monetary policy. But Chinese authorities are traditionally good at boosting investment, but they have rather limited experience in boosting consumption, especially in the short run. Now, given the supply side overcapacity, weak external demand, boosting investment has proven now to be very effective. So the focus now is how to really effectively boost consumption. In theory, Chinese authorities can copy other countries' practice to distribute, for instance, consumption coupon, even make income transfer directly to household. However, in practice, old habits die hard. They opt for the traditional indirect way, namely through boosting investment, thereby creating jobs, income, and then trickle down to consumption. But if this traditional way of stimulating demand fails to work, I suspect, and I won't rule out the possibility that Chinese authority would eventually result to some income transfer program or consumption coupon program to boost consumption directly this time around.
Okay, so let me put it this way. Would you roll out the possibility of consumption coupons completely? So because, so based on the feedback mechanism, it seems to us that the Chinese regulator has quite a healthy feedback mechanism. I would say probably better than than lots of other markets. And on the other hand, as you just mentioned, we have never seen such thing, this kind of stimulation previously. So combine that, would you roll out the possibility completely?
No, I won't rule out, and I think this time is different. If the traditional measures for stimulating demand fail to work, I won't be surprised if Chinese authority would adopt some kind of income transfer or consumption coupon distribution policies. In fact, some of the local provinces already started to do so, but in a somewhat smaller scale. Yeah.
Yeah, probably as a pilot program,
Yep.
right? As Chinese regulators always do, they tried with the smallest scale pilot program. If it works, it will expand it to the whole country, right? Probably. Let's hope for it.
Yep.
Okay. So Stephen, I want to give the question to you is about the federal fundraise. So we would say that the federal fundraise is picking on at least on the horizon, right? So do you think people should feel more optimistic about emerging markets? And if so, where do you see opportunities among these markets?
So the short answer is yes. I think they should feel optimistic about emerging markets. And certainly over the most of my career, when I said that, I meant equities. But now there are opportunities in emerging markets in both equities and fixed income, as well as limited opportunities in terms of private investment as well. So emerging markets have, in many ways, if I can say this, been more responsible, especially with their fiscal balances, than in some of the developed market countries. The emerging markets rather famously don't have some of the demographic issues, or at least some of the emerging markets don't have the demographic issues that the developed markets have. So we think there are opportunities in both. I think just to give you a couple of examples, we are pretty positive on India's structural and fundamental story. It's kind of bottomed out in March, and the Indian equities have rallied, but we still see opportunities there. As there is a lot of changing in the outsourcing and reshoring of different investments, we see a lot of opportunity in countries such as Mexico, being so close to the United States. Its equity markets performed very well this year, but there's pretty massive investment, primarily from US companies, going into manufacturing in Mexico right now, and there's a lot of opportunity there. In terms of fixed income, we see a lot of opportunities within the Southeast Asia, where yields are pretty much higher than they are in the developed world. And so it's an opportunity to pick up some yield versus for a global bond type of portfolio.
Stephen, we have been, so when we talk about developed market versus emerging market, and I think there has been good reasons to diversify away from probably US market to emerging market for a long time, right? And some of the reasons just mentioned has been in existence for multiple years, even close to a decade. So why do you think the time is like, so now is the time to really to act to allocate more into emerging market?
So I've spent a good portion of my career, the last 40 years, trying to encourage developed market investors to invest in emerging markets. And over that time, had they done that, they would have done very well. Emerging markets have outperformed. But we've seen a phenomenon now for a while, or 10 or 15 years, where the United States market has just been incredibly strong, outperforming not all markets, but almost all markets, and including emerging markets. And I think there's probably going to be a leveling out. So let's say in 15 or 20 years ago, the United States was roughly 40% of the market capitalization of the world. Now it's 60%. So I don't think it's going to go to 80%. So I think that it's likely that the dollar will weaken over a period of time. I think if the U.S. economy does have some strength, that'll be strong for emerging markets. I think emerging markets have performed pretty well, and in terms of the management, the governance of countries. You have to be selective, but many of them have, and the makeup of emerging markets has changed very differently. When I first started, emerging markets were basically commodity driven, and then they were really export driven. And now many emerging markets, and particularly China, is very much what I would call innovation driven or technology driven. And I see that going forward. And I think there's just a lot of opportunity there. And then obviously, just in terms of pricing, emerging markets are relatively inexpensive. And I guess finally, I would say in terms of global investors, most of them are underweight emerging markets at this point. So I just think there's an opportunity there, primarily in terms of relative pricing.
Okay. So do you think I'm not sure. Do you think there are less probably quality managers focusing on emerging market compared with developed market, especially US market?
Absolutely. It is very tough to add value if you're just investing in the US growth market, because as you probably heard about, 7 stocks, they call them the Magnificent Seven, are really driving the whole performance. Whereas if you look in emerging markets or China, it's much more an active manager situation where someone who's really focusing on the market can add a lot more value.
So it's easy to be a mediocre manager in the United States, right? Because I'm sorry, I meant to be.
Maybe a different way that I would put it is that I think a good manager can add a lot of value in the emerging markets or China. And it's much more difficult for a manager to add value in particularly large capitalization US stocks.
Okay, you put it in a much nicer way. Thank you. Okay, so Dr. Wang, speaking of emerging market, China is is the largest emerging market. And I want to bring up a specific industry, the internet companies. And we have, in previous interview, we have covered this sector quite substantially. So what's your view toward this internet or tech giants in China at this point? Do you think they have enough upside for investors to add to their positions?
Yes, we do. We are generally bullish on Chinese internet companies, especially these large cap platforms. And we think their performance will be driven by valuation multiple re-rating after 2 years of derating and top line growth recovery in the remainder of the year. I offer 4 specific observations. First, as a secular trend, the mobile engagement time span is peaking in China, but the cyclical recovery in advertisement remains on track and is expected to gain further momentum for the rest of the year. Second, the policy and regulation normalization is key for platforms, which is real and credible with increasing predictability. A case in point is that probably you know the recent draft regulations in generative AI, which we believe could set the industry on a good footing with clear boundaries, regulatory boundaries. And third one is that there are at least 2 additional sources of growth stemming from a reacceleration of cloud growth due to increased adoption of hybrid and public cloud of various industries. That's number 1. Number 2 is that for the international expansions with the immense opportunities, of course, there are geopolitical challenges. So last but not least, share repurchases by those companies is also very welcome because it is a very concrete a meaningful way to improve shareholder returns.
Okay, so what about competition, rising competition in the industry? Do you think it will add pressure to the top players because the latecomers are act quite aggressively?
Well, good question. If you ask this question, like say 3 years ago, I would say this is an important factor, and then the potential competition to challenge the existing giants. But with the regulation put in place over the last couple of years, and with now the normalization of regulatory environment, I would see the competition landscape for the internet companies become even more favorable to the existing companies.
Well, that's interesting. You think the regulatory action actually has helped to consolidate the industry, right?
I think the regulatory action over the last couple of years help consolidate the sector and help strengthen the competitive strengths of those existing companies. I think so. That's why we expect kind of a valuation re-rating for those companies on top of the top line growth recovery.
Well, that's very interesting. I would say probably a general, well, that's my view, restrictive policy probably always favors the top players in the sector because they have more resources to navigate through the new uncertainties, right?
Exactly, fully agree.
Okay, that's a very interesting point. Next, I want to shift to some long-term picture. I want to bring up so retirement investment because China has a aging population. So, and I know both of you are very passionate about retirement investment. Stephen, how should you asset managers encourage individuals to get prepared for their retirement? Do you have some insight to share with us?
Well, I think that the situation for retirement for United States is very different than China. Chinese have a greater virtue of saving than Americans. So Americans are famously consumers. And so many of them are not actually prepared for their retirement, unfortunately. And while there is some government safety net, it's not very big. So that is a big issue in the United States. In Europe, a little bit less so because there are very strong government retirement plans. But certainly, I'm sure you have people of a wide age range on your show. So the big secret is really to start investing early. It's really quite amazing how wealth compounds over a period of time, and it's really best if you can start investing and being a regular investor as soon as you can. That is a trait that many Chinese people have. I think a very positive trait. And then I think that you really probably want to have a very long-term perspective. While it's somewhat interesting to listen to what people think about what returns will be over the next couple of months, what you really should be concerned about is what will the returns be over the next 5 or 10 years, and try to think about that and align your investments so that you'll do well over a longer period of time. What I don't know very well in China, but it's very important in the United States, is to look at your tax situation and try to invest in such a way that you have a high return after tax.
That's very helpful. So Dr. Wang, even so, Stephen mentioned that we have like the mindset or the saving mindset, but I think there is another side of the coin that is we tend to like invest too conservative. I'm speaking for myself that even though at the early stage of my career, we would equal retirement investment as conservative investment, but that is a wrong mindset, right? So could you help us clarify what do you take as the correct way to prepare for our retirement?
I share your observation, Yuan, and I also think Stephen made a exactly right point in comparing the different situation in the US and China. China has one of the highest household saving rate in the world, now standing like 35%. So I suppose one of the reason behind this high saving rate in China is that Chinese folks must have been saving very aggressively for their retirement. The key is how to convert this abundant savings into high quality investment for retirement purpose. As it stands now, Chinese household savings are primarily invested in two forms of assets. One is that the saving deposits or wealth management products provided by commercial banks. I believe, Juan, maybe you belong one of them. And the second type of investment is the real estate property, both of which are now the ideal investment instruments for retirement purpose. So the issue is not lack of demand for investment, but lack of suitable investment products for retirement purpose. So here in this case, the question really, the key question in this regard is how asset management industry should work hard to provide suitable investment products. In today's Chinese market, there is a scarcity of low volatility investment products with decent returns, and which can sustainably generate income out of savings when people retire. So to this end, it really calls upon investment management firms like Templeton, like Chongyang, to do a better job to serve our clients. Of course, the tax issue that mentioned by Stephen also important. And in this regard, I think Chinese government should also consider some incentives for people to save, and more importantly, to invest for the long run.
Well, I think that's very helpful because I totally agree with you. We need more products that investors feel comfortable to diversify from deposits to products that they feel comfortable with to as a starting point, at least, right? So I kind of exhausted my question for this session, and I will step back, let you both ask each other two questions. So Dr. Wang, shall we start with you? What's your first question for Stephen?
Yeah, I do have questions, Stephen. I know you have been with Templeton for 28 years, and you have played a critically important role in growing this company into a global asset management giant. I wonder, to what extent the fact that Templeton is a publicly listed company has contributed to its extraordinary success?
Well, I think it's interesting because in the United States, some of the biggest asset managers are not public. I would note that Franklin Templeton, while being a public company, is controlled by a family. So it's a little bit different than some other public companies. And I've actually been associated with Franklin Templeton since 1984. So quite some time. At which time, when that first started, it had $10 billion under management, and now it has $1.5 trillion under management. So probably one of the biggest growing asset managers in the world. And so I think that being listed has been a way to grow the company. The company has not needed financing during that time, but it has been a way for us as employees to share in the growth of that company. I would say that it has been good to have kind of a good balance between being public, but also being controlled by a family. I'm now working for the third generation of that family. That's always had a very long-term view. And I think it's many public companies don't have a long-term view. And so I have always, and I can say this very honestly, been able to have a long-term view with my clients and not been pressured to do anything that I didn't feel was the right thing. And that's really incredibly important to me. So yes, it's been great to be a public company. A lot of bigger companies are probably not public now. At different times, we've looked at whether we should go private or not, but being public has been a good opportunity for us. Very recently, we acquired another very large asset manager, Legg Mason. And so being able to use stock as a currency, we actually paid cash, but being able to use stock as a currency and incent employees and everything has been very important. So I think our growth, particularly the growth in being able to make acquisitions, it's been important to be public.
Stephen, do you have a question for Dr. Wang?
I do. I'm just so happy and thrilled for the amazing growth of China since I studied and worked in China in 1982. Growth beyond what anyone would have expected. But now we're looking at a situation where China has a different demographic profile and may have some struggles and even have secular growth problems going forward. So I'm wondering what you think about that, and what do you think the prospects for technological innovation are for being the primary driver of growth over the long run?
Oh, thank you, Stephen. Very, very, very good questions. I think indeed in facing these secular challenges like demographics profile, I think for China to continue to grow, technology is key. Innovation is very important. On this one, I'm quite positive on the prospect for innovation in China. Well, the U.S.-China tech war will likely slow the progress, to be honest, of innovation in China. I don't think it will stop China from innovating. In this regard, I'm a believer of this challenge and response theory pioneered by the great historian Arnold Toynbee. And according to this theory, meet the challenge heads on, help a country or an organization to survive and prosper. But having said that, I would like to emphasize one key precondition in this regard, which is, I think, for China to remain innovative, China shall remain open to the rest of the world. Therefore, benefits from the free flows of knowledge, information, and free flows of cross-border financial and human capitals. That's very important. That's the key.
Interesting. Thank you.
Stephen, do you want to ask you a second question as well?
My second question, yes.
Yeah.
Dr. Wang, I was kind of telling my story of going from a very rural place to China, but I understand you were on the plane going the opposite direction. You grew up in Inner Mongolia, and you traveled to the University of Maryland. You got a doctorate degree in the United States, and then you remained in Washington, D.C. and worked for the IMF. Tell us about that experience.
Oh, thank you. Yes, when I traveled to the States in '94 to pursue my doctorate degree at the University of Maryland, back then China is still very poor country. As you know, you've been in China even earlier than '94, right? Probably the biggest shock to me in terms of perspective. And now it's after studying in the U.S., working in the U.S. now, and return back to China, and witness the tremendous progress China has made. I'm always amazed, how lucky I am in experience this great development, great change, and also make me more appreciate what are the key driving forces for China's success. I think again, as I already indicated in my previous answer to your question, I think for China to continue to develop, to grow, to become as advanced as the U.S., China need to remain open and allow open to new ideas, open to new technology, and open in terms of financial and human capital flows. Allow folks like me to go to US to study, to work, to learn, and come back to help China, and allow folks like you to come to China, to understand China, to explore opportunities, again, bring the expertise in the US to help the development of Chinese market, eventually to help, better the living standard in China.
Well, that's wonderful.
That's
Dr.
great.
Wang, you're
Well, I was just going to
Dr.
say,
Wang.
I so strongly agree. I'm very involved with the Chinese Society here. I'm the executive sponsor in our company of the Asian Society. It's very important to have that communication between countries and cultures.
Oh, wonderful. Dr. Wang, do you want to ask your last question?
Sure, Stephen, I also did some homework. Christy Tan, who is your colleague, we used to work with her on the same team at Bank of America, many years ago. So I did a bit of homework. I was told you are a passionate and veteran swimmer. So my question is, what's the most memorable swimming experience you ever did?
Oh my, I am a bit of a crazy swimmer. The quick story is that when I was a young man, I had, in my 20s, I had back problems. And so the doctor recommended that I learn to swim and become a swimmer. So I've actually become quite a significant swimmer. I swim probably 10 to 15K a week. But my most memorable swim, I've swum all over the world, in Brazil, in Asia, in China, in Australia. But I did, and I've swum the Alcatraz swim, which is rather famous, but the hardest to swim was across the span of the Golden Gate in San Francisco. It's a difficult swim because there's very high current, very cold water, and occasionally a shark. And so that was challenging. And while to go across, it's probably only about 5 kilometers, you have to swim much more than that because the current carries you the other way.
Yep.
So I got quite cold and wasn't sure that I was going to make it. But I'm very happy that I made it. And that convinced me that I don't want to do any more of these cold water swims. So now when I swim in warmer water.
Oh, that's so amazing. Okay, so that's what we have for this session. That's so wonderful. We have quite a rich conversation. We have some historical notes. Dr. Wang remind us some knowledge from history, and we have some information regarding sports. So that's wonderful. So next, let's move to a quick question session. Would you please provide punchy answers with no explanation or very quick explanation? So shall we start now?
Sure.
Okay, so what's your top risk to watch for the rest of this year, Stephen?
They're a little bit combined, just briefly, geopolitical risk, but also just unknown risk. There's somebody out there that borrowed a whole lot of money when interest rates were low, leveraged themselves, and are going to get in trouble. But by definition, we don't know who that is.
Okay, so what's your relative safe haven for this year, Dr. Wang?
In terms of investment, I think the safe haven investment will be U.S. long duration bonds and the Chinese A shares.
Okay, Stephen.
Yeah, I'd absolutely agree on the U.S. 10-year at 4-year at over 4%. That seems to make perfect sense. I'm not sure I'd see Chinese A share as a complete safe haven, but it's an interesting choice.
Okay, so tell us one lesson you learned that you wish you have known earlier, Stephen.
I wish that I'd been a little bit calmer and had a longer term perspective and not gotten so anxious about the short term situations.
Okay, Dr. Wang.
Well, I used to underestimate the importance of narrative as opposed to numbers when it comes to valuation of stocks.
Oh boy, that's a really good point. That's a really good point.
Okay, so the last question. So what would you advise to a fresh graduate who aspires to excel in the asset management industry? Stephen.
Yeah, I think of a few quick things. Get your CFA, your Certified Financial Analyst degree. It's a great degree. It's hard, but you should do it. Secondly, find yourself a mentor. Go out there and find somebody who's 20 years older than you are or more, who's been in the industry and been through the good times and the bad times. Ultimately, I think the big opportunities are where the markets are not efficient. So you're going to find better opportunities being bottom up than top down. And for young people right now, that's probably private markets. And then finally, something that Dr. Wong mentioned before, but I really do think as much as you can get experience in different cultures and global experience, I would try to do that. So if you're in your 20s, spend your energy learning and worry about making money and building your career when you get older.
Okay, that's very helpful. Dr. Wang.
Asset management industry is one of the most exciting industry to join as a professional. To survive in this industry entails a skill set featuring a combination of strong analytical, interpersonal, and presentational skills. But to thrive in this industry would require passion, hard work, and constant learning.
Okay, that's great. Well, that's what we have for today. And I thank you both for your participation. This is wonderful. I learned a lot, and I hope you enjoyed the conversation as much as I do. Thank you, gentlemen.
Thank you very much.
Thank you, Juan. Thank you, Stephen.
Thank you.
Thank you, Dr. Wong.
Thank you. Enjoy the rest of your day.
Thank you. You too. Bye-bye.
Bye. 正如刚才两位嘉宾分享的，无论是全球市场还是中国市场，今年剩余时间可能还是会面临比较大的不确定性。在这样的环境下，投资者朋友可能还是需要保持警惕，保持理性，分散投资。更多精彩节目内容尽在中国基金报对话栏目，感谢您的持续关注，我们下期再见。